Great. Let me get started with to welcome you and thank you for joining us today. We certainly hope all your families, colleagues are staying safe and healthy. And we're really excited, I think, about the webinar today. It's been just over a year since the pandemic started, which really changed how we live and work in a very dramatic way. Back then, I thought we were sending our staff home for 2 weeks, and that's turned into a year and more than a year now. I do think at the beginning of the end is here with the vaccinations going on and that event that happening. So that's all really great for us in terms of looking forward. It's been 6 months since our last webinar with the same panelist. And we're taking a little different approach to our questions this year in terms of starting very specifically around the Canadian marketplace and the mortgage and real estate business specifically. But in this ever-changing year, hearing our panel's outlook on the economy and the industry, that one segment of the industry has been seemingly undeterred by the pandemic, with the exception of about a 1-month period of adjustment, and that's been the real estate industry. As many of you know, the purpose of these events are to bring you together, share discussions with industry leaders on the housing and mortgage market trends, the economy in general, expectations for the future. And today we have some very good questions, I think, but I'm certain that we'll have some excellent responses from our panel. A little bit of housekeeping just before we get started. We are recording this session, and we will provide you with a link afterwards. You can ask questions through the Q&A feature on the system through WebEx. You will be on mute through the process though. If you're having any technical difficulties, if you put a note in the Q&A part or in the chat, we'll get to you and help you get logged on. We're about 35 to 40 minutes of questions and then 10 minutes for audience questions that we can run through. At the end, we'll give you a quick questionnaire to get your feedback on today's session. It helps us formulate the future sessions and what we do and your enjoyment of that. We take that feedback very critically and important to us to set up the next sessions. Now, the reason that we're here, let's get down to the economic power panel. And really, I don't need to introduce these gentlemen. I'll give you their names just for the sake of introducing them, but that's it for that. And then we'll jump right into the questions. So we have Benjamin Tal from CIBC World Markets, Derek Burleton from TD Bank Group, and Robert Hogue from RBC Royal Bank. Thank you, gentlemen, for joining us today. As always, it's a great conversation, and I'm sure you're looking forward to sharing lots of interesting information on the marketplace in general. So let's jump right into it. We'll start with maybe one of the harder questions, and it's that everyone seems to have gotten the forecast wrong. When last we met, actually last spring, we had some forecasts, and then again in October, the market was full of lots of surprises, lots of things happening, but I think that everyone's forecast was off a bit. And I'll say maybe with the exception of Phil Soper from Royal LePage, who somehow sees the rainbow in every marketplace. And has been right in a lot of cases on that side. But there have been those surprises, and most surprising to you is what we're trying to get to. Maybe we'll start with that question just on Robert, what your thoughts on the market, what you've seen, and some of the surprises.
Well, of course, the obvious surprise is how strong the market is at this point. If we roll the clock back to a year ago, with all the market activity slowing down considerably last spring, we did expect some kind of pop-up activity, but just because of the pent-up demand that had built up. But we thought that by the fall, things would start to calm down and kind of resettle at a kind of a lower baseline than previously. And looking back at it, not even close. Now we're setting new records month after month in terms of home resale activity, and as well the tightness in the market that existed pre-COVID got even tighter over the last 6 months, such that now prices are not just rising, we're rising at accelerated rates. So it's been the kind of outcome that we just even 6 months ago would not have expected at this stage. And looking back, some of those factors, like low interest rates and high household savings, it sort of makes sense, but really was hard for us to imagine at the time.
Yeah, very true. And Benjamin, your thoughts on things that surprised you out of, what your forecasts were and what actually took place?
What do you mean surprise? I predicted it exactly to the decimal point. I remember exactly 6 months ago, exactly to the decimal point. Listen, yes, it does. It is a surprising performance. And again, as Robert say, when you think about it, it actually makes sense because there are two things happening here. We have seen interest rates going down dramatically. So when you have interest rates going down dramatically, this is a boost. Now, what we are seeing now is something very interesting. We are getting the benefit of a recession vis-a-vis lower interest rates without the cost of the recession, namely the damage to the labor market. Usually when you have a recession, interest rates go down, not as much, but they go down. But at the same time, you have job insecurity, you have all kinds of things happening, impacting everybody. And therefore, people cannot take advantage of those low interest rates. In this environment, given the very asymmetrical nature of this crisis, namely, basically all the jobs lost were low-paying jobs, as we all know. In fact, high-paying jobs, their number went up by 350,000. So you have this asymmetrical damage that you can enjoy the benefit of low interest rates without worrying about your job because you're zooming. That's the opportunity that you were looking for many, many years. Interest rates are so low and your job is secure. In fact, your income is rising. So again, you can get the benefit without the cost, something that led to this rally in the housing market. And then there is another factor that is happening now, which I believe is simply borrowing activity from the future. Because there is this urgency to get into the market. If you don't get into the market now, you are missing on those extremely low interest rates. So parents are putting pressure on their kids. Do that, we will help you. And the help is coming and is growing. So I think that's what's happening now at the expense of tomorrow. So I think that's explaining. So again, economists, we can explain what happened. Sometimes it's difficult to predict this kind of environment. Again, we were not surprised by the fact that the market was positive. We did not expect the market to go down, but we didn't expect this kind of activity reflecting those forces. This is a very abnormal situation.
Yeah, I think abnormal is a really good word, and we can apply it to so many different things in terms of our other questions. How about you, Derek? Your thoughts on surprises in the marketplace?
Yeah, I think both Benny and Robert covered it well. I think really at the core, you had a market that was quite hot. I mean, it seems like an eon ago, but pre-pandemic, the market was hot. Now add on, I mean, mortgage rates fell by more than 100 basis points, and as Benny said, the unemployment rate shot up, but it just didn't have much impact because potential home buyers weren't as affected. A lot of that was in low wage jobs. So, I mean, that really is at the core. And then you start sprinkling on some of the pandemic fear of missing out, race for space, all layering on, and now maybe some speculative froth. I mean, there's a lot of uncertainty as to what extent that may be creeping in the markets. Frankly, we don't have a lot of good data on it, but it's really a layering on that has been so surprising and has led to huge undershoots of forecasts.
Right. Maybe continuing on, Derek, just your thoughts on the housing market, just the incredible activity on both prices and sales volume. Is that sustainable? And then what your thoughts on what the spring market looks like if we're not in it already?
Yeah, and I think that's a great question. I think one needs to distinguish when you say, is it sustainable? Are we talking longer term? Are we talking price growth? Clearly not. I mean, seeing Chatham prices growing at 70% year over year is not sustainable. Or you look across a lot of the markets that are benefiting the most from, some of these pandemic trends, clearly not sustainable. And we'll come back to that. I think we'll probably focus a bit more on the longer term outlook. But in terms of your question on the spring market, yeah, I mean, trend is your friend. I don't see anything that's going to get in the way of another really strong market. I know the third wave has been a concern economically. It may show up very soon in the job numbers, but again, we know who gets hit the hardest by restrictions in a lot of the low-wage service industries. So I don't see that being a huge barrier. I mean, we know the resilience of the economy and the housing markets. So And just that'll push preferences, won't it? And then the other thing, and again, I'm sure we'll get more into this, with rates now starting to back up the other way, and I see this beginning a trend. We are in recovery. We heard from the Bank of Canada, rates are going higher. And if anything, that may pull forward some demand. I think Benny referred to that. You got some of these macro-prudential proposals being looked at around stress testing rates. That could pull forward demand to the spring. So now, are we going to beat the March results? I think jury's out on that, but at the very least, we're going to see sustained that kind of eye-popping, impressive strength through the spring market. Good news is listings are growing quite strongly. Good news in the sense that that's going to add juice to sales. But price growth, we have to be a bit careful because now we're dealing with year-over-year comparisons that compare to a year ago when things were so weak. So got to look through those a bit. But I think even when you do, probably further price gains as well, even on a month-to-month basis. Not huge, but because the starting point has been so strong, but still ongoing gains. And the industry data we've had so far in April, either from Toronto, Calgary, do support some of this. It's going to be quite the spring market.
It definitely feels that way. Robert, just taking that comment about the house prices and the increasing at an incredible clip, you wrote recently about the year over year, the aggregate prices up, single and double digits in many, many markets, and incomes are growing maybe at a slower clip. So here's the question, where is all that money coming from to buy these homes?
Obviously from many places. I mean, a lot of people are borrowing more. You look at mortgage credit, they're up. It's up 7% year over year, which is now the strongest growth rate in a decade. But there's also tremendous equity that's been built up over the years, and especially over the last 12 months with prices rising so rapidly in many markets. That's allowing a lot of people whose housing needs have changed, and as already mentioned, people are moving further away. They're bringing their equity with them to make a purchase in other markets. And lastly, there's also this bank of mom and dad we've been talking for many years now. It's still arguably probably very active. I mean, that too is kind of a kind of factor that we don't have a really clear line of sight on. But anecdotally, I think it's pretty compelling that many, especially for first-time home buyers, are getting help from others, from parents more specifically. So it's probably a mix of all of those. If I were to place a bet somewhere, I think this movement of equity especially from core urban areas towards the suburbs and exurbs and smaller markets is probably a big factor in what we're seeing right now.
Well, that's a great lead in actually to our next question for Benjamin. And all the talk in the past year, that race for space, moving outside the cities, do you expect that to change? Let's call it a boomerang effect where people are going to move out and then they echo back into those marketplaces.
Yes. First of all, let's go back to where the money is coming from. Clearly, parents are playing a significant role here. We have seen a significant increase of about 30% in the number of parents that are being used as guarantors. So it's not just gifting, it's also being used as guarantor. This is a trend that is starting now. The other factor that we are seeing is basically a significant jump, almost doubling, in the number of borrowers that are using their house to generate income, namely renting space, namely the basement. This is something that is happening in Vancouver a lot, but now it's starting to happen in Toronto, Montreal, and other places. So people are using their house to generate income, again, reflecting the sense of urgency. I want to be there and I will generate this income regardless how, just to be there. So that's something that is happening in a big way and will continue to happen. I think that's something that we have to consider in terms of additional income that sometimes, by the way, is not captured in official numbers. So that's a big trend. Regarding the moving away, the Toronto refugees, if you wish, yes, it's there. But if you look at the overall level of transaction, and you look at Toronto, and about 300 kilometers from Toronto, and you look at transactions in this area, it's about 5-6% of overall transactions after the jump. So it's a big story for those small places, but it's not a big story in terms of the overall transaction level. Toronto is still the center of the world, and that will continue to be the case. And in fact, I think that it will be more so because I see Toronto, Vancouver, I see cities being revived. I think that people will come back to the city. I think that we are reaching a situation in which in some pockets, in remote areas, you're reaching a resistance level. The premium on living in Toronto went down. At one point, people will start questioning this premium. Maybe it's too low. We have seen it in Vancouver a few years ago before 2017. And the best view of the Toronto real estate horizon is from the Vancouver Harbor, because Vancouver is leading Toronto. And what happened there is that the premium of living in Vancouver went down, namely prices outside Vancouver went up more until reached a point where it stabilized and actually started going up because people started to realize that they are missing too much not being in the city. The minute Toronto will have something to offer, and it will because things will open up, the attractiveness of Toronto will come back and you will see people coming back. That's one thing. The other is that you bought a house in Barrie, an hour and a half from Toronto, assuming that you will be working from home forever. That's a big assumption. Your employer might tell you, listen, I want you back. Then what do? You rent an apartment, a condo in Toronto, the way people do in Manhattan, Berlin, and London. That might happen. That actually will lift demand for condos. That's one thing. The other is that maybe your current employer is fine with you working from home. What about your future one, your new one, another one? So that might impact labor mobility. We have to think about all those things. It's not. I don't think that the office model is dead. I think it will be back, not to the same extent. It will be very different. But I think that just assuming that you will be working from home all the time is a bit tricky. And this has might have some implications on the revival of cities. And if you talk about cities, clearly you're talking about condos. And that's why I believe that the condo space will outperform low rise over the next 2 years.
Yeah, very true. And I think we're already starting to see some of that effect on condos, maybe more particularly in the Toronto area, whether it's people who are saying, I can't afford even moving out to Pickering, and that condos are becoming more of an option. It's going to be an interesting dynamic to watch, I think.
And there's also an issue of supply there as well. I mean, condo supply has been much more plentiful downtown Toronto than other forms of housing.
Yeah, definitely. If we look further out, so the rest of 2021 and into 2022, Aubert, maybe you can give us some of your expectations on the resale market and house prices there.
Yeah, I mean, let's start with the very near term, and I agree with all that's been said, like Derek's assessment of the current situation. I mean, the market extremely strong right now, and over the coming, like through the rest of the spring and probably early summer, we're likely to continue to see very strong activity. And if anything, the activity is being restrained by the supply side. So if we get more sellers in the market, new listings, you're going to see those numbers. I'm not sure if it's going to continue to match what we saw in March, for example, on a seasonally adjusted basis, but it will remain historically high. Now, that also implies that the market remaining very, very tight, prices will continue to rise, and so this will contribute over time to deteriorate affordability. And this is, if we think now over the second half, later this year into 2022, I think the issue of affordability is going to become much more present. It's going to contribute to some cooling demand over time. And if over on top of that, you layer, a creeping up of interest rate, longer term interest rates, these will contribute to kind of a slowdown on the demand side. Probably not enough to rebalance the market very quickly, but at the margin start to moderate the kind of price increases we've seen, at least on a year-over-year basis. So we do expect that over through the remainder of this year into 2022, we'll see housing home resale activity moderate from a record high, beyond from the stratosphere. So when you tally all up, 2021 is going to be another record year, more than likely in our view. Increases, I think we're calling now for a year-over-year increase of 22% or over 20% home resale 2021 relative to 2020. But by the time you get to 2022, however, this is where you're going to see the numbers start to reverse, down 20%. But talking here for all of Canada. But we would not consider that like a housing crash or anything. It's just like a return to kind of more sustainable levels of activity. Price-wise, continue very strong price increases in the near term. Probably is going to show up in double-digit increases overall for 2021, but then starting to moderate, getting into the low single-digit by 2022. And if you look at it, for example, on a month-by-month basis, I would not be surprised to see some outright declines and by the latter stages of 2022 in some markets. Probably not overall, but in some markets. So, and that will be a reflection of kind of an improving balance between demand and supply.
Okay. Benjamin, maybe we can get your comments on two different segments, one the rental market and the other on new builds.
Yes, the rental market clearly went down. Rent in Toronto is down by 10%. Under cities, even more than that. And we know why. It's not a big surprise. We have seen a significant decline in demand because of students, non-permanent residents, immigration, and some increase in supply, especially in the condo space, that 2020 was a very strong year when it comes to supply. So you have this situation, and then you have the Airbnb factor that, released more supply into the market, so the market is down. I believe that the market is down but the fundamentals of the market haven't changed in any significant way. Namely, if you look at the rental market, let's say in mid 2022, early 2023, it will resemble, in my opinion, 2019. I think that will be the same story, namely a very tight market. We have a break now, but the fundamental issue is that there is demand with very limited supply, and that will continue to be the case. I believe, quite frankly, that the only solution to our affordability crisis is a rental solution. I think that rent must be part of the discussion. I believe that purpose-built must be part of the discussion. And if you really believe that we have to do something about affordability, you have to tackle rental and you have to break the negative stigma associated with rental. And I think that's starting to happen, and I think that's the direction. The way it is in other big cities where demand is larger than supply. And that's the only way, from a long-term perspective, to deal with the affordability crisis that cities like Toronto and Vancouver are facing. When it comes to new construction, we have something very interesting. We have a situation in which, if you look at the condo market, prices in the pre-construction market, namely the pre-sale market, did not go down. All the correction in the condo space was in the resale market. In fact, the gap between pre-sale and resale is a record high in terms of prices. Now you go back to this in history and you see, okay, what is the correcting mechanism? Namely, whenever you have this kind of gap, what's correcting? And usually resale goes up to catch up with pre-sale. Add to it that construction costs are rising at a rate we haven't seen in many, many years. We all know the story. You cannot find trades. You cannot get a reasonable deal on lumber. So we know that construction cost rising. Developers, although they are all millionaires, are complaining, and rightly so, because we are paying the price. So that's another factor that will impact the price of pre-sale. So I believe that the correcting mechanism will be actually higher resale market in the condo space over the next year.
Okay. How about, Derek, let's switch over to interest rates and get your feeling on where those are going, both the interest rates for mortgage rates and where the Bank of Canada rate's going.
Well, good timing. We just put out our updated forecast today on our website on rates and yields. So an important event was last week when the Bank of Canada released its updated outlook, updated guidance around rates. And I think many, I'm not sure on the panel, anybody who wasn't surprised. I was a little bit surprised by the extent of the hawkishness in that statement. And it's enough that it caused us to pull forward our expected first rate hike by the Bank of Canada roughly a year. We were at the tail end of 2023. We're now looking at end of 2022, fourth quarter. Now it's still a ways off, but still, seemed like several years away. I think that day is coming a bit quicker. One thing in the Bank of Canada, again, pretty optimistic statement. It jumped from being among the most cautious, negative, pessimistic forecasts on the street to the top of the consensus now with 6.5% growth for Canada. It means that it expects the economy to kind of fully recover, at least from the headline. We know the K-shape and not all industries are recovering at the same time, but at least seeing an absorption of slack by the second half of next year, and hence why we think at that point they're going to be finally pulling the trigger on rate increases. Now, in terms of yields, we see one direction on that as well. We think that yields, even through the third wave, have hit a bottom. We've seen them already back up. I think 5-year yields are up they're up a total of about 70 or 80 basis points off their low, but we see another 50 basis points of increase by the end of this year, another 40 basis points by the end of next year. Obviously, a strong link between those trends and 5-year mortgage rates. So, that's not insignificant, particularly with pricing as high as it is. It will erode some of the economics of buying. Still leaves rates relatively low. I wouldn't say those are high rates, but enough that I think it's going to contribute to kind of cool the market. I think Robert is right. It'll take a while for this to kind of feed through, but I think next year you're going to start to see more visible impacts on demand, even if sales don't go back to below average levels. Certainly take away some of the froth that we've seen of late.
Right. It does seem like the potential rise in interest rates is also one of those driving factors of people trying to get into the market right now, in addition to the increased pricing.
Yeah, absolutely. Yeah.
Let's move on to, I'll call it government intervention, or what the government can do in terms of the market. And Robert, we'll start with you just in terms of that OSFI, the stress test, and how much impact do you think they'll have? Do you think that's going to continue to change?
I don't think it's a game changer for the market. I think it probably will have a sort of an impact, a cooling impact at the margin, and unless it's being followed by other kind of measures, this in and of itself is probably not going to do it. Like can be that big one measure to rebalance the market. But then again, in the context of if this is supplemented by a similar kind of measure for the insured mortgages side of things, plus creeping up of mortgage rates over time, plus this current borrowing of activity from the future. At some point we'll get into that future, which will be possibly later this year. I mean, those kind of the cumulative effect could be enough to start cooling the market to a certain extent, but in and of itself that measure is probably not going to be that impactful.
Okay, you mentioned actually the mortgage insurers, and that was one of the questions from the participants is, do you think that they'll be following along with a change to the mortgage insurers stress test?
But to be honest, we were expecting that to see that in the federal budget, and the federal budget didn't go there, and I don't see why this would still not be on the table. Again, it's a tweak. I mean, it's not a huge measure, but this is kind of the direction we want at this point from policy perspective, and the advantage of this as well is that you can it will be revisited. OSFI said we'll revisit at least once a year that qualifying rate, and so there could be, once we're in a different set of circumstances, you don't need to cool the market as much. then you can calibrate it properly to ensure that it's still in line with what the market needs.
Okay.
If I can make a few comments on this. First of all, let's go back to interest rates and the impact. Clearly, it is going to take a while, but we have to remember that the effectiveness of monetary policy is much stronger now than it was in the past because of the level of debt and the nature of new borrowing. So I estimate that the 1% increase in the effective interest rates is basically equivalent to 2% increase just 10 years ago. So the effectiveness of monetary policy when interest rates start rising would be very, very significant. The Bank of Canada would be very powerful in slowing down the economy, given the increased sensitivity to higher interest rates. So that's one aspect that we have to consider. The other is the issue of interest rates and the risk of inflation. Yes, we expect interest rates to rise, but I think that there is one aspect that as a risk factor we have to take into account. The reality is, let's face it, nobody knows what will happen to inflation. With the economy operating at this rate, with the Bank of Canada printing, we know the story. Nobody knows what will happen to inflation. When I say nobody, it includes the Fed, it includes the Bank of Canada. They can tell you until they are blue in the face that everything is under control. They don't know. Which means that if for some reason, inflation is not stabilizing after rising, and it is rising now for a base effect or all kinds of factors, and let's assume it stays there at 2.5, 2.7, and they are telling us that they are willing to tolerate it for a while. What is a while? And how high is high? So the point that I'm making is that inflation is a lagging indicator. Inflation is like this brown spot on a banana. By the time you see it, it's way too late. So the point here is that if you wait for too long, you might be chasing a lagging indicator. And when you do that, you overshoot. And you react too rapidly because you're chasing something that is lagging. To me, that's the number one risk. And it's a risk. It's not the main case scenario. It's the risk that is facing the housing market and the economy as a whole. Because if you start raising interest rates, remember, Greenspan in 2006, whenever it was, he raised interest rates from 1.25 to 5% over the course of breakfast. It was basically very rapid. What will kill the market is a rapid increase in the interest rates. And that's why I like the fact that we are more hawkish now, if you are the Bank of Canada, because you will start raising rates earlier, not in 2023, in 2022, which is a good thing, which is another factor because the market today, even today, is still discounting a situation in which the Bank of Canada will start raising interest rates a full year before the Fed. I'm not sure what the market is smoking. It's not going to happen. There is no way the Bank of Canada will be raising interest rates before the Fed. The opposite should be the case, especially if you care about the loonie. So that's another factor. But overall, I totally agree that interest rates will be moving in the end of 2022. And that's a very positive scenario because it means that maybe they will go up more slowly as opposed to being or chasing a lagging indicator.
Okay, very good thoughts on that. Derek, Robert mentioned the budget, the most recent federal budget, and I want to get your, I guess, comments on what your thoughts of the budget was and its potential or expected impact on the housing market.
Yeah, I think one of the biggest surprises of that budget was the lack of surprises. Really didn't see anything. I mean, there had been certainly some concerns in the weeks leading up. The government may implement some large tax increases, some talk about principal residences. You know, in the days before, didn't think that would happen, but there's always a shred of uncertainty. But in the end, it didn't. And what it did implement on the housing front was fully expected. That 1% annual tax on the value of vacant non-residential owned homes, that'll be effective in January. That was fully expected. That they anticipate will you know, sort of garner about $700 million over 4 years. So, you know, they do see some impact from it, but I throw that in the same camp as Robert. I don't see this being a hugely influential tax on the market. I don't think many of us do believe, even with some of the limited data around foreign investment, that it's been the overriding driver of the market. Clearly, it's more of a domestic story. And we did see when BC implemented a similar property tax type levy, it didn't seem to have a big impact on demand, and even on supply. I mean, there's some talk that it could lead to more rental supply, more listings. We didn't really see it at least show up very visibly in some of the BC oriented data at the time. So, yes, it'll cool to some extent, but we don't see it being a big game changer. In terms of the other components, there were some housing supply measures, again, pushing some of what Benny was referring to on the supply side, construction repair, but 36,000 housing units, fairly big amounts are allocated, billions over 7 years, about $2.5 billion. Real focus there on supporting the vulnerable communities, through rental construction that's tailored. So again, those measures were fully expected and kind of flow into the inclusion agenda, the current government.
Right. Okay. Thank you, Derek. Benjamin, just going on now that it's been brought up on that supply side, there's been a lot of talk about trying to fix the supply side. How do you see that fitting, and what can you do for the supply side to fix that?
Well, you have to build more. And I think that we have to free land much more quickly. The low-hanging fruit is really with municipalities. It takes forever to release land. That's one thing. In places like Toronto, you have to modify the Places to Grow Act in a way that will release more land. That's one thing. Then we have to be more creative in terms of the speed at which we build houses and the cost of those houses. If you look at research and development, overall the economy, real estate is the last sector in terms of growth and spending in R&D. We basically do the same way we did things 20 years ago, while the rest of the world is changing. So R&D in real estate must be very important because demand is rising way too quickly, supply is not catching up. So that's another factor. And then we have to basically change zoning requirements in a way that will allow you to actually create more purpose-built rental and give developers the incentives to do so when it comes to taxation, when it comes to development charges. So that's another factor. And then we have to look at inclusionary zoning, basically change zoning activity to include low-income Canadians in each building. I think we can do a lot of things in the supply space. I don't see it moving. We are doing a lot of things in the demand side of the equation without touching the supply. While the issue is supply, we are using demand tools to fight the supply issue. And surprise, it's not moving, and the market is still very hot. We must address the supply issue in a very fundamental way. There are many ways of doing it. One of them is clearly release more land and accelerate the speed of approving housing activity.
Okay, so here's maybe a closing question on this one particular area is, what would you recommend the government do to modify or slow down that marketplace, or should they even be doing that? So I'll leave that open to any of you. Robert, you had your hand up, so I'll maybe go to you first.
Well, I just wanted to add to Ben's point there on the supply side. We do see a supply, like a builder's response. And when you look over the last several months, housing starts have been incredibly strong. I mean, and the number of housing units under construction is at a record high. At some point, that supply is going to be delivered to the market. So the issue with supply side, or the challenge with supply side measures is that it takes a long time to have an effect. Hence, if you want to have a quick effect on the market when it's overheating, you use a demand side kind of measures. And I would strongly, with respect to more specifically to your question, and by the way, that the construction, builders are building more purpose-built rentals as well. Obviously not enough, but there is some supply response there as well. I would continue to encourage all levels of government to focus on making the supply side more responsive to the market. Now, Ben was talking about releasing more land. That's one aspect, but also its approval process that has to be less burdensome and quicker. Because if you talk to builders, they're going to say, "Now, yes, we have some land. It just takes sometimes 6-7 years to get it, to get some kind of zoning changes or whatever it is before their project gets approved. And so it takes, way too long to respond to the changes on the demand side. And demand, you look at from a demographic perspective, it's only going to go up, assuming that Canada will eventually hit its increased immigration targets. It means we'll need more housing units out there to accommodate more people moving to Canada, and those people are converging typically to just a few centers in around Canada. So obviously, supply side is something to keep focusing on to make sure that is becoming more responsive. And again, I think to have a more immediate impact, making some more tweaks on the demand side to cool down, especially maybe focus it if there's more and more evidence of a speculative activity, just make sure that it doesn't take hold of the market, because then you're getting to that a spiral that could be damaging down the road.
Okay. How about you, Derek? Any thoughts on what the government should be doing or not doing in this time?
Yeah, I'm actually happy that they appear to be treading a little bit carefully. There was a lot of growing pressure for the government among analysts on Bay Street to start looking at all the taxes across the board, somehow break this demand cycle. I do see it really since the pandemic being more of a demand issue than supply. I mean, that was, I think, certainly pre-pandemic supply, a lot of challenges there. But I mean, I look at the listings growth and it's surging. It's just demand is even more explosive. So, and Robert talked about some of the starts activity and the like. So demand is exorbitant right now, and we're not sure, I mentioned this earlier, to what extent speculation may be creeping into the market. So I think job one, we need more data, we need more information. Hard to start levying, say, a flipping tax when you don't really have a lot of good concrete information around the behavior of speculators and to what extent. So I think the job one, they're looking at this proposal on stress testing. At least they've got something there, and a bit of a lighter touch on the macro crude. I don't think it was a bad thing, and given the fact that they've already tightened up the those restrictions quite a bit in recent years. So a lot of safety levers are already in the system. So that's something they're working on. Let's get some data, and then if the market doesn't cool, particularly as vaccine rollout, and to Benny's point, we start to get some flow back, it looks like things are out of control still, then maybe you do have to look at some added taxation, but hopefully we'll have more information at that point to make a well-educated policy decision.
Very good. And Benjamin, just getting your thoughts on what the government could do, but maybe specifically after that, getting your thoughts on who's going to bear the brunt of all this spending from a government perspective and the programs they have going on.
Well, first of all, we have been relatively quiet when it comes to telling the government what to do, because quite frankly, I don't think that OSFI or finance need us to tell them what to do. They are very familiar with the issue. They talk to us on a regular basis with all the banks. They know exactly what's going on. So it's not a question of advice. It's a question of what they're willing to do and what they're not willing to do. Second, exactly as was mentioned, we have to realize that this specific issue, namely what we have seen over the past year, is a demand shock given limited supply. Namely, those extremely low interest rates, they are the reason. And I'll give you an example why it's so different, because in 2008, interest rates went down, but still the economy was down. The housing market was down for a while. Today, of course, it didn't. Now, interest rates now are clearly lower than they were in 2008, but if you add stress tests, they're actually higher. So from a qualification perspective, interest rates are higher than they were in 2008. Still, the market is up. Why? Because of the abnormality of the distribution of the pain in the labor market, as we discussed. So this is a very unique situation. We have a demand shock. Now, if you respond to this demand shock with an array of long-lasting changes, you can actually do more damage than good, because the issue is simply those extremely low interest rates and the abnormality of the distribution in the labor market. There is nothing you can do about it in a very fundamental way, besides waiting for interest rates to rise and this demand from the future to be utilized. I think that's the way we look at it. So yes, you can do things at the margin, which we did, and you can continue to do things at the margin, but it will not change the fundamentals of the market. Therefore, from a demand side, yes, you can clearly go after speculators. You can clearly do all kinds of things in the bidding process, get rid of the blind bidding process, stuff like that. But it will not really be a game changer, unfortunately, because of the nature of the crisis. So from a long-term perspective, the focus must be still supply. Now, who's going to pay for it? No, nobody. Of course, nobody. You know, Margaret Thatcher said in 1980s that governments are like families. They have to, they have to, balance their budget. They have to pay down their debt. No, governments are not like families. The Canadian government, to go back 100 years, hardly pays its debt. They never pay their debt down. They roll it over. And that's exactly what will happen this time around as well. You don't pay it down, just roll it over, and you take advantage of low interest rates. And despite the fact that the debt to income ratio, the debt to GDP ratio went up from 30% to 50%, interest payments are actually down. Clearly, we know why, because of low interest rates and refinancing. What it means from a long-term perspective, of course, it means that the economy as a whole is much more sensitive to the risk of higher interest rates. And I see, in fact, a permanent increase in government spending. Government spending as a share of GDP before the crisis was 15%, went up to 35%, crazy, unsustainable, will go down. But when it stabilizes, it might stabilize at 17, 18% of GDP. This is a permanent increase because without even noticing that, we are putting together the plumbing for tomorrow's social assistance program. We have a universal or national daycare system. That's going to be very costly. There are other permanent changes that we are going to see. To me, this means that eventually, and this eventually will be a year, 2 years from now, taxes will have to rise, including the higher inclusion rate on capital gain tax.
Okay, that's great. We're sort of at the point now, we're going to take some questions from the participants out there, and we tried to work a couple of those into the conversation already. But one of the questions came from a participant on the return of the tourist and its impact on the economy, as well as immigration. We're going through this time when housing sales are going crazy without a whole lot of immigration going on. Just getting comments on that.
Let me start on that, if I may. First of all, let's look at 2020 and look at population growth in 2020. Stats Canada is telling you that population growth was down from 500,000 to 200. And I suggest that Stats Canada is undercounting population growth in Canada for two reasons. One is returning citizens. We have 500,000 Canadians residing in Hong Kong. I estimate that already about 70,000 of them came back to Toronto or to Canada, most of them to Toronto and Vancouver. And we know that for many, I won't get too much into it, too technical, because Stats Canada really doesn't count them. But we have a significant number of people coming back, and given what's happening in Hong Kong, more will come. This is underestimating population growth in 2020 by 60,000 to start with. And we know that they're sending their money because we speak to developers in Vancouver, Toronto. Hong Kong money is coming like there's tomorrow. And you cannot blame them given what's happening in Hong Kong, and that will continue. That's a major source of demand, but also supply of money that will come. That's one thing. The other is those students. There are about 70,000 students in Canada, foreign students, that their visa expired in June, July of last year. And the government told them, listen, you can stay with expired visa, that's fine because of the situation. However, Stats Canada's, their model, the minute the visa expired, they don't exist anymore. They're out. So which means that we are undercounting another 60, 70,000. So roughly about 120, 130,000 people that are in Canada that we are not counting, which means that population growth was actually higher, stronger than the headline number. That's number one. Number two, clearly, those new immigrants are coming back and their number will be rising. We are lowering the requirements for new immigrants in terms of the point system, which means that it will be really easy to attract some, and many of them are already in Canada. and then you will have the students coming back. So I believe that by mid-2022, we're going to see a significant increase in the number of new arrivals with major implications for the housing market. And that's one of the reasons why I believe that the rental market will go back to what it was in 2019.
Okay. Derek, your thoughts on that?
Yeah, I'm like Benny. I'm pretty bullish on the population story. I guess the question, it will rebound. The question is when, and you know, we may wait a few quarters, but I think you know, 2022 and beyond, you know, we may, and also we may not get back quite to the peak that we were at, you know, in 2019, that kind of thing, 18, 19, but we'll get pretty close. So I'm still bullish on that fundamental story. I think, Joel, was your other question on tourism?
Yes.
Just trying to think, but just, or the question, I should say. Yeah, that hard to be with, you know, we're still as a world working through the third wave, in some parts, fourth wave of the coronavirus. So it's going to be a pretty slow reopening on that front in terms of international tourism. You know, we'll get domestic tourists flowing more freely before that as vaccines continue to roll out. And that's been a good news story of late, that we've seen vaccines really pick up in Canada. And hopefully we don't go through the same kind of hesitancy that we're now beginning to see in the United States and in pockets. But that I think will help the domestic story. But, you know, with a lot of the countries of the world still dealing with it, it's certainly going to keep reopening in terms of reopening to international tourism very slow. Your guess is as good as mine. You know, by the end of this year, do we start to see restrictions being eased? So yeah, that's one, I think, hopefully more of a 2022 story, but that should contribute to some of the good growth we've got in our forecast.
Okay. Robert, maybe I can get your comment on one of the questions from the participants as well, is the markets in the East Coast, maybe specifically around Halifax, but in markets there, they've seemed to have been less impacted by the pandemic overall, but certainly a lot of strength going on in those markets. You have any feelings on what's going on in the East Coast?
Affordability, work from home. We're seeing that movement, like we've seen in from the core of Toronto towards, or major urban areas toward the suburbs and exurbs, and there's been some movements also towards Halifax and other pockets in Atlantic Canada. So not just Halifax. We've seen some very strong growth in Moncton as well, for example. So it's largely, you know, a search for more affordable housing. And now that working from home is unchaining people from in the downtown head office kind of work in some cases, not everyone, but it allows that opportunity to work remotely as far in the far places in around Canada. So I think when we'll look back, maybe when we do, you know, this kind of an assessment years from now, we'll be looking at this COVID-19 as being probably significantly positive for, you know, regional developments. It opens the door for a lot of smaller communities to grow, and that includes markets in Atlantic Canada.
Okay. So we're just about out of time, but I do want to open it up just to the panel. Any last comments on anything we either covered or you want to cover more on, or anything we haven't covered that you want to bring up?
Well, maybe just to echo what Derek said with respect to vaccination. This is all, we're all kind of praying for those vaccination campaign to give us the desired outcome to get control of the pandemic, and so we're all and bring some normalcy at large, but including in the economy and for the housing market as well. So crossing our fingers that we'll get months by what is it, September? I think our Prime Minister is promising by September things will start to look more normal than they are now.
So if we can talk about the trajectory of the recovery in the second half of the year, more to the fourth quarter of the year, assuming the trajectory of vaccination is according to plan, there are three factors that will lead to this very strong recovery. One is the fact that the nature of the crisis is very, very deep, but also very narrow. Namely, the damage is very deep because if you feel the pain, you feel the pain. If you're in aviation, restaurants, you feel the pain. But the number of industries that are impacted is relatively limited compared to any other recession. So it will not take too much to recover after we have the green light. So that's one aspect. The other is that the damage is in the service sector. We all know the story. You press a button and you get your exercise bike. So the impact on the goods segment of the economy is not so significant. It's all services. That's the bad news. The good news is that services are more flexible. It is much easier to start a new restaurant than to establish a new manufacturing facility. So the speed of the recovery will be there. And the third factor, of course, is the cash factor. We are sitting on a mountain of cash. We all know the story. I estimate roughly $100 billion of excess cash just by individuals, another 130 by businesses. And I remember, the finance minister is asking, how can we convince those people to spend that money? And I said, provide the vaccine and get out of the way. They don't need any encouragement. They are motivated enough. So those three factors, I believe, will help to see relatively strong economic growth, assuming, and that's a big assumption, the vaccine continues to be utilized in a normal way.
Yeah, I guess just a final word on inflation. Benny raised it as a key risk, and I completely agree. I think forecasters generally kind of look to the past. We've been burnt before forecasting rising inflation, but the ducks are all lined in a row. Now, how the Bank of Canada, the Federal Reserve manage that is yet to be seen. But if there's going to be a miss on inflation, it's probably going to be on the upside, and that obviously has implications for rates. But our baseline, to his point, is still predicated on the Bank of Canada achieving its goals with gradual rate increases.
Right. Okay, well, we're just about out of time. I did want to thank Benjamin, Derek, and Robert very much for your time today, joining us, your insights, and that continuing support. That's tremendous. And also thank you to our audience for joining us today and participating in the session with the questions and things like that. At the end of the session, you'll get a quick survey to complete. We'd love you to complete that, so we'll use that feedback for future sessions. We have been recording this, and we'll share that recording with you. If you have any other questions or comments, just please reach out to the RPS team. If there's anything we can do for you, additional data, whatever it might be, we're happy to be there. So let me close by saying we hope you and your families and colleagues are all keeping safe, and that by September, according to our Prime Minister, that we'll all be back outside and enjoying freedom. So again, thank you very much for joining us today, and that will bring an end to our presentation.